Hey, Bulls and Bears, we're back with another dose of economic reality. Today is Wednesday. It is April 19th, 2023, and we continue to document the slow motion collapse of the economy where debt is increasing and increasing and increasing. Certain debt seems like it can go up without any repercussions. Look at the national debt. 10, 20 years ago, even economists that were considered experts wouldn't have guessed, that the debt would be this much nationally. But now we're finding out that everybody's finding out that you can just create this money endlessly. So there's no limit to this debt here. But there are areas that does have limits. I'm talking about you and me and your typical household budget because we don't get to create our own money. So yes, this debt, household debt known as consumer debt, is not going to be just one of these things where you sit there and watch it increase endlessly because we have to make payments on it. We can't just increase the debt ceiling ourselves for our personal household budgets. And, the rubber's hitting the road right now. We're seeing businesses lay off like never before. We see 5 times the layoffs this year already. By this point last year, compared to this point this year, we're about 5 times as many layoffs as we saw last year. So it's getting very interesting. And layoffs is just part of the picture. Well, let's go ahead and get into some recent news here. Now, I want to start with Bank of America because recently, let me adjust this camera a little bit. Recently, Bank of America and other banks reported earnings, and earnings looked pretty good for the most part. But if earnings was just the only thing we should look at, how do you explain this next story? Today, Financial Times, Bank of America plans 4,000 job cuts. 4,000 job cuts. Brian Moynihan, CEO, says the move should not be seen as a sign that it's bracing for a business slowdown. So 4,000 job cuts. And actually, this comes after about a 1,000 position job cut in the first 2 weeks of this month here. Brian Moynihan said the bank earnings cuts were prompted by a cooling jobs market. Now, we reported a few months ago that a lot of these big banks were setting aside money for potential loan losses. So we knew that the banks were bracing for something. But listen to this. This is the not so headline news here for the banks. And this is just a Bank of America in particular. Listen to this. The bank's unrealized losses in its bond portfolio is about $103 billion. And that actually shrunk down to that number. It was actually bigger than that. Unrealized losses in the bond portfolio, $103 billion. So these loans they have on their books that were given out at rock bottom interest rates are now not worth as much because interest rates are much higher. Remember, even in the stress tests that the Fed did against the banks, they never accounted for higher interest rates, right? So even the experts out there, the Fed never thought that higher interest rates would remain this high for this long. They never saw inflation coming, when actually even people here, myself and you, knew inflation was coming, and we knew inflation wasn't going to be temporary or transitory because we don't have enough manufacturing.
Noble Gold Investments have made it their mission to stay on top of the most important economic news. 3 bank runs in the last month. These are the second largest and the third largest bank runs in history. The government is taking steps to guarantee all deposits. That means more money printing. Plus, the Fed is sitting on unrealized losses of $1.2 trillion on their $8.3 trillion bond portfolio. And the Fed could continue to raise interest rates until they crash the economy. Do you know who are the only ones that are not afraid? The ones who are invested in gold with Noble Gold Investments. Gold is the most stable asset outside of any government control. Thousands have approached Noble Gold Investments to get their hands on gold. Hurry and go to bullboomgold.com to secure your wealth now. Bag a free 5-ounce America the Beautiful coin with each gold or silver IRA if you qualify. Go to bullboomgold.com. That's bullboomgold.com. The link is also in the description of this video.
And we have to import everything. Not everything, but a large percentage of what we import. Now, speaking of that, let's take a look at some numbers out of China. We know that China manufactures a huge amount of what we consume here in the U.S., and therefore they have very low inflation. I've got some numbers here in front of me of how low inflation is in China, and this is the cost of living, and that's the type of inflation I'm talking about. 2021, 0.85%, well, less than 1%. 2022 was 2%. 2023 is projected to be 2.24%. So very low inflation. I don't think it's a coincidence at all, do you, that manufacturing is a key component to the China economy. And here they have very low cost of living, low inflation. So here in the US, we need to do the same. We need to bring back manufacturing. We need to start producing our own stuff here. And other than that, there's not going to be much relief in sight for this inflation, especially now with a lot of countries going away from the dollar. We're in a very dangerous position here, relying so heavily on imports and the world de-dollarizing. Speaking of de-dollarizing, it's becoming mainstream now. There's a lot more news out there about this. Even mainstream business outlets like Bloomberg are reporting on this. I saw it on like Fox and some other channels, even CNN. De-dollarization is happening at a stunning pace. And listen to this. The dollar is losing its reserve status at a faster pace than generally accepted. The greenback share in global reserves slid last year 10 times the average speed compared to the last 2 decades. 10 times the average speed of the last 2 decades. Other countries saw what we did as far as how we sanction other countries and lock them out of the SWIFT payment system, for example, known as weaponizing the dollar. Countries took heed to that, and they noticed that. And even our allies, or countries that were considered our allies, are now looking to trade and are trading outside of the dollar. Look at what's happening in Brazil, other countries in South America, trading amongst one another, trading in yuan, trading precious metals integrated into their trades, oil. We've got Saudi Arabia now on that same bandwagon. We've also got output cuts from the OPEC nations, and we know that we're not energy independent here in America anymore. So it's going to be rising costs at the pump for you and me and for U.S. consumers. So we're seeing a lot of inflationary forces coming up here at the same time as we see this credit crunch with a lot of the smaller and regional banks really tightening their lending because of what's happening right now with the banks. And we just talked about Bank of America earlier with their huge unrealized loss on their bond portfolio. A whole separate item to look at is these derivatives exposures from the big banks. We know that those run in the 10 trillions of dollars, right? So we're definitely not out of the woods as far as this financial crisis goes. And it's going to be very interesting in this battle of inflation versus deflation. A lot of people just put it out there as it's going to be stagflation, which we have seen in the past, but I think it's going to be to a whole new level this time here going forward. So because of that risk of inflation, I always say we need to stack hard assets. You can do it with your retirement account now with our sponsor that we just heard from earlier. You can accumulate, you can fight against this. Every time you accumulate hard asset, especially silver, in my opinion, you're fighting back against the manipulation and you're fighting back against the endless currency creation. More on the layoff news here. Open Door cuts 22% of its staff in a new round of layoffs. This is the second major round of cuts at the iBuyer since November. Now, this is largely because of the real estate slowdown. Of course, Open Door is involved in real estate. So we're seeing, buyers stay out of the market. But it's interesting in the housing market, we're also seeing sellers not that desperate to sell yet. Inventory's still pretty low. A lot of these people that bought their homes bought at rock bottom interest rates with mortgage rates around 3%, sometimes even slightly lower than that. So a lot of people are saying they're not moving up, and they're definitely not desperation selling at this point. But it's going to get harder and harder for these people that paid, a lot of money for their homes to keep their head above water here, especially coming up this summer. So we're going to have to see what happens to inventory this summer. Plus, a lot of sellers wait for the spring and summer selling season to put their home on the market. So we'll have to keep an eye on that, see how this plays out in the next few weeks and months here in the housing market. But another article out of Bloomberg, Americans go deeper into debt as they use buy now, pay later apps for groceries. So now people are not only running up their credit cards, now they're buying things like groceries on these buy now, pay later apps. You go into a lot of stores, even if you buy something online, they want you to finance it. When I bought my camera here to use on this channel, Amazon, they wanted me to finance it and pay I think it was 12 payments of whatever it was, like $80 or something like that. So another form of taking on debt without actually swiping a credit card. but it still goes under the category of debt. And as a household, again, you don't have the unlimited capabilities of holding debt, right? Like we see with the national debt again, for example. Let's talk about more real estate here. Mortgage foreclosures are rising now very slowly. And I've always said here it wasn't going to be a crash, that it was going to be a slow motion collapse. This is happening in very slow motion. The number of homes in various stages of foreclosure rose during the first quarter here, and now they're up 29% from a year ago. Now that seems like a lot, but remember, foreclosures have been ultra low, especially with the moratoriums that went on starting in 2020, and they ended in late 2021, maybe early 2022. I'd have to look it up, but nonetheless, they were ultra low. So looking at these year over year numbers, even though 29% seems like a big increase, it's still pretty low when you look at it on a total numbers perspective. But they are increasing nonetheless. If the economy was so strong, it seems like foreclosures would be decreasing. But remember, what kept a lot of people solvent through these times was the forgiveness, the rent cancellations, the mortgage forbearance. We have cities like Los Angeles now getting rid of the eviction moratorium. So about 240 something thousand households are behind on their rent. You look at 1, 2, 3 people in each household, we're talking about 500,000 to 750,000 people could potentially become homeless here in the coming months if they don't do something, if they don't re-implement the rental assistance program there, the renter protections. So we're going to keep an eye on that. That's Los Angeles. Other cities have similar tales. Some cities actually, believe it or not, still have the protections in place for the renters. That shows you the state of the U.S. consumer and how many people are really in dire straits right now financially. All right, folks, we're going to wrap this one up. What do you think about the Bank of America layoffs, the $100+ billion unrealized loss on their bond portfolio because the loans they give out at ultra low interest rates? These are loans that they're still holding on their books that they couldn't find a buyer for or didn't offer for sale. And who's buying the bonds from the banks right now that are getting rid of their bonds? We see the Fed unwinding their balance sheet. So the game is changing, folks, and we're going to keep an eye on it here for you. If you like what we talk about, please give us a thumbs up and a subscribe. I know a very small percentage of the people that watch the videos here actually subscribe. So if you can take a second, please make sure you're subscribed. You really help us out here. And we'll hopefully see you again here next time. Keep stacking. Bye for now, everybody. Peace.